So you make $50,000 a year and you're thinking about moving to Florida. We're going to go over how to calculate your income, some of the acronyms you might hear on a regular basis, ratios for different type loans, and down payments. So let's get into it. Thanks for visiting the channel. This is all about living in Tampa. My name's Chris, and we do videos in regards to moving to Tampa, what it's like to live here. Today we're going to be going over, if you're thinking about moving, different financial information that you might need to understand how much you could afford if you decide to move down. So you make $50,000 a year. Today we're going to go over the qualifying ratios for conventional FHA and VA loans. I'm going to show you how to calculate your debt to income ratio, which is your DTI. And we're going to show you a maximum sales price you can purchase based on those ratios. So when we're talking about income, we're talking about gross earnings. So that's before taxes are taken out of your paychecks. You're going to take that $50,000 in this scenario, you're going to divide that by 12, and you're going to have an income of $41.66. If you have alimony or child support, we can use that as well if it's court ordered and you have received it for 6 months and you have 3 years of continuance, meaning you're going to receive it for at least another 36 months after the closing. Second jobs, we can use those in some cases as well. If you have a second job and you want to use the primary job and the secondary job, we have to have a 2-year history of you working at both those jobs. If you had, worked at one job for, let's say, 5 years, and you started the second job, you've been there about 1 year and 2 months. Unfortunately, we can't use that one. We can only use the income from the job you've had for 5 years. On the plus side, you can use, some of the money from the second job. We can document it, source it. You can use that for your down payment or assets that you need to close. We just cannot use it for income. Also wanted to just point out, when we're talking about $50,000 a year, we're talking about W-2'd employees. If you are a 1099 employee where taxes are not taken out, self-employed, something like that, like a contractor, you could have some possible issues that we need to discuss, because you have to have a 2-year history. If you're moving to Tampa, because that's where we're, a lot of our viewers are checking us out. If you're moving to Tampa and you have a W-2 job, should be fine. Maybe we need 30 days of pay stubs. If you're working for the same company and it's a transfer, that's no big deal at all. There's no issues. If you are moving your business here, or if you're in a sales position, you're 1099 and you're moving here, those could be potential issues that you want to discuss with your banker, your lender. If you need to ask me any questions, I'm happy, to answer those. You can shoot me a text, email, send me a comment, and we'll reply back to you. So that has to do with income. Now let's look at debts. Debts that are going to be included in your ratio are going to be things like a car, credit cards, student loans, alimony, or child support. Those are things that are going to be factors when we're working within those debt to income ratios. In this scenario, we used a figure of $325 for a car payment. Credit cards, $250 a month. Student loans, I left at 0. Maybe you're on an income-based repayment plan based on where you work. If you are going to be looking at conventional loans, there's different factors that we look at, whether it be conventional, FHA, or VA. If it's a conventional loan, and not to get into a lot of different things, but if we're going with a Fannie Mae loan, they're going to take 1% of the balance of your student loan unless there's a payment listed on the credit report. With Freddie Mac, it's a 0.5% unless it's listed on the credit report. FHA is going to be a 0.5% of the balance as well. And then with VA loans, it's different. They're going to take 5% of the balance and divide that number by 12 months. And that's where they're going to come up with their figure. When we're talking about what's not included in those debt ratios, we're not going to take your current rent. We're not going to take your utility bills, cell phone, bills, insurance, car insurance, different things like that. Don't play factors in our debt to income ratios. So in this scenario, we got $41.66 a month in income and $575 a month in debts. You're going to divide those two numbers into each other, and we're going to come up with a ratio of 13.8. Not to confuse this ratio with what you see like front and back end ratios in case you're doing some research online. When they're talking about front end ratio, that is going to be the mortgage payment, the total mortgage payment, PITI, principal, interest, taxes, and insurance, divided by your monthly income. And the back ratio is going to be your principal, interest, tax, insurance, that monthly mortgage payment, plus these debts divided by the income. So let's kind of look at those numbers. If your income is $41.66 a month gross, let's get into talking about what ratios are going to be with conventional FHA and VA loans. Conventional loans standard are going to be 28.36, FHA is 29.41, and you're looking at 41 on the back ratio for VA loans as well. But although some banks, some lenders, some investors might hold to those ratios, that's not real world ratios. Right now, we're seeing average ratios being around 45% or less will work on the back end ratio. If you're putting down more money, you have very good credit, you have some additional assets or reserves after you close, you might be able to go as high as 49.99 on conventional loans. Once you hit a 50% back-end ratio, it's going to decline it no matter what. With an FHA loan, you're talking about as high as probably 55. Not to say that you should go that high, and we'll kind of talk about that too, but VA loans, again, 45 or so or less would typically work. If not, you're going to have some compensating factors. You're going to have maybe some additional reserves, residual income, are things that we look at. So anyway, just because we can qualify you at a higher amount doesn't necessarily mean you should. If you're buying this house by yourself or you're buying it with a significant other, what you want to do is have a discussion about that. See where your comfort level is. Put your budget together. See what you're comfortable paying. I would try to hold tight to that number so that way you don't start looking at properties that maybe are outside of the budget, because then once you see it and maybe you want it and then you push yourself to do it, and then maybe you're not able to do some of the things that you enjoy doing, maybe going out to eat, maybe traveling, some different things like that. So anyway, let's get back into looking at these ratios. 41.66 a month in income divided by that ratio of a 45, or multiplied times 45%, is going to be 1874.70. That's going to be the maximum mortgage payment, including your debts, that you qualify for. So the PITI is going to stand for principal, interest, property taxes, homeowners insurance, and private mortgage insurance. You might have an HOA. If that's applicable, you got to throw that figure into that number as well when we're going to be dividing this out, and we'll kind of get a little bit more into that. Private mortgage insurance is going to be what's required by all lenders for conventional loans, unless you have 20% as a down payment. If you have an FHA loan, then what you're going to be looking at is a funding fee up front that gets rolled onto the loan, and then you have a flat 0.85% with the minimum down payment that is going to stay with the loan for the life of the loan. VA loans, there is no private mortgage insurance. They just have a upfront funding fee. Getting into some other things with VA, first time you use it, it's going to be cheaper, that funding fee. Every time thereafter, it's going to be 3.3%. You have the minimum 10% disability, and then that can get waived. So I know we're kind of getting into quite a bit of other factors. If you have some more questions about that, like I said, comment below, send me a text, email, be happy to answer those questions for you. So if we're looking at max 45% debt to income ratio, that's 1874. You're going to take that figure minus your recurring debts that you have every month at $575, and that's going to give you a figure of $12.99 a month. That's going to be the maximum principal, interest, tax, and insurance, and a HOA. Factor that in there in case there's an HOA in the community. That's going to be the $12.99 a month. The reason why I separate the HOA is because that's not going to be included in your mortgage payment that, you know, your statement that you receive from the lender. You're going to always pay that separately, but it's still a factor that gets worked into your ratios. So anyway, that's why I put some little notes here. The normal mortgage payment is only going to be the $1,299. Make sure you factor in if there's an HOA. Variables that are going to come into play are going to be your credit score. It could affect the interest rate. It could affect the PMI factors for conventional loans. Your down payment, you know, VA, there's no down payment required unless you go over the standard limits. You know, if you're going into a jumbo VA, then there could be some down payment requirements. Conventional loans, you're looking at minimum typical is going to be 5% down. You can go as little as 3% down based on, you know, particular situations. And then with FHA, 3.5% is going to be the minimum down payment. Terms of loans are going to, you know, be another factor to look at. 30-year fixed loans are going to be standard for the industry. And then you're going to have some other options as well. You may be able to look at a 25-year, a 20-year, or a 15-year. But you got to keep in mind that as you decrease the term, the monthly payment is going to increase quite a bit. And we already went over in terms of VA disability. If it's 10% or more, you could be exempt from the funding fee. When you get into VA loans, then if you have a copy of your certificate of eligibility, you can check that out and it'll actually tell you if you're exempt or not. If not, let us know. We can pull that for you with a copy of your DD-214 or the you know, your release. All right, so let's go ahead and get into looking at that payment, $1,299. You know, Fannie Mae actually has a site, knowyouroptions.com. We're going to use their mortgage calculator. We have a calculator for purchases, for refinances, and affordability. We'll put that in the comment section below. That way you have a link to it. Feel free to use that. It works really well. It actually also pulls in actual PMI factors based on whatever credit score you put in there. So if you have an idea what your credit score is, you can throw that in there and it'll give you accurate PMI factors, which most of the calculators out there that you can find and use for free. I haven't found one yet that's doing that, which is why you know, we offer this to a lot of our clients. Anyway, you know, in this scenario, we kind of worked it up a little bit already. You know, a $200,000 purchase price with 5% down on a 30-year fixed term with the interest rate around 3 1/8, because right now you could be anywhere between possibly 3 to 3 1/4 or higher, depending on the credit scores. Again, you know, those are factors that come into play. That would give you a monthly payment of approximately $1,287. We figured $1,299. So here's a breakdown on it. You know, principal and interest, $814. Taxes and insurance, $333. HOA of $42. And PMI of $98. You can actually click on the advanced view tab right here. And if you want to manipulate the homeowners insurance figures or HOAs or property taxes, you can actually do that as well, which is nice. And then you can actually hit see results and it'll give you a breakdown. You know, when you're looking at this, I would be a little careful though. You know, you can expect to pay, it's got a breakdown there, no problem. Expected funds needed at closing, it's got your down payment and then your closing costs. Closing costs, they only put at $5,000. You know, that's probably fairly accurate, but the problem is they're not including into that number your prepaid expenses, which are your prepaid interest, you know, from the day you close until the end of the month. That's a figure that's, you know, should be in here. Also, the insurance company is going to collect your first year's worth of homeowners insurance up front, and then they'll escrow probably an additional 2 months. And then your property taxes, they're probably going to escrow, you know, 2 to 3 months of that as well. So, you know, that could be an additional easily $2,000, if not more. So I think this figure's off a little bit. But outside of that, it's good just to toy around with. You can go back to the calculator and we can, you know, manipulate this a few different ways. Let's say you've got 10% to put down. you can see with 10%, that's going to drop that monthly mortgage payment to $1,212. If you had 15% down, it's going to drop the payment to $1,166. It's also going to be affecting that PMI factor as well. So keep that in the back of your mind. Now, let's go back to 5% down. That's at $1,287 figure. We also talked about term. Let's drop that 30-year term to 20. It's going to actually increase a payment from $1,287 up to $1,539. So you can see by just changing the term of the loan, let's go to 25 years, that's $1,387. You know, there's some different options. I mean, what I usually, talk to some of my first-time buyers about would be go with a 30-year term. If you have the, after you get into the house, you're comfortable with the budget, typically everyone has increases in pay, or they're improving their situation, over the years. If you have extra money, or you receive a tax refund, as an example, you can actually pay extra every month. There's no prepayment penalties typically on the standard loans. What you can even do, if you ever hear of, bi-monthly payments, half payments, what people are doing in those cases, they're actually paying every 2 weeks, right? Half a payment. If you do the math, there's 52 weeks a year, 26 half payments are what they're making, or 13 full payments. So in this case, let's just say your payments are, $1,287 a month. If you just make an extra, let's say $105, $110 additional principal every month, you're going to be doing the same thing, and that'll reduce the mortgage from 30 years to 23 years. 7 years difference. So even if you don't plan on staying there 30 years, you're paying down that principal. It's almost like a forced savings plan, to be honest with you, because you're getting that much more equity in the house. So that way, when you do eventually sell it, maybe you're going to upgrade in homes, you're going to be able to sell it and gain that much more back when you do sell it. So something I like to kind of talk about with people is making those extra payments, especially when if you can be disciplined enough and just plan on making a little bit of extra payments every year. If you're not, maybe you get bonuses. Send in an extra payment or two every year. Or like I said, if you get a IRS refund, plan on, instead of using it all and going on a trip or something like that, maybe take half of it, apply it towards principal reduction. It makes a huge difference, I will tell you that. And then that way you're gonna be in that same situation where maybe you pay the loan off in 20 years or so, even though you have a 30-year mortgage. And one other thing I wanted to mention, there's a lot of questions I get in regards to right after somebody closes. There's a lot of marketing material that gets sent out to the clients, and it looks like it's addressed from, our company or whoever they close with, right? Originally, that is all mass marketing, where once you have all your documents recorded, there's companies out there that will pay to get those names and addresses and so forth. And what they'll do is they'll market to you. Let's say it's insurance, maybe it says something like, hey, for $50 a month, you can get this insurance plan, and if if you ever passed, they would pay off the mortgage. Well, I wouldn't suggest doing something like that. I'd suggest getting a homeowner's insurance policy to cover the house, let's say. That way, if you have a significant other, it'll pay that mortgage off, and then they could still stay in the property, or they could sell it, or they can do whatever they want with it. But it's going to be probably cheaper depending on your age. Those are things you got to look at. But the policies that they're talking about sending you from these, marketing companies, they're basically talking about, let's say you bought a house for $200,000. Let's say you stayed there for 15 years and now you only owe about $50,000. And then, God forbid, something happens to you, they are only going to pay off that $50,000, even though you've been paying the same amount as maybe a term life insurance policy that, would have netted you $300,000 or $350,000, right? So talk to a financial planner about that. If you need one, I deal with one down here. He's great. His name's Rob Collarette over at Ameriprise. I have my own personal stuff with him as well. But Anyway, if you have any additional questions, anything else I can help with in regards to answering some questions about the video, or anything else you want to know about, hit us up, shoot us a text, call, email, put something below in the comments, and look forward to seeing you on the next video.